All right, hey, Josh here with Stanek Financial. Hey, let's talk about whole life. And boy, I tell you, this product gets lampooned in the financial industry from Susie Orman to Dave Ramsey. I tell you one thing is, Dave Ramsey, I like his tenant, I like what he does. I think he does good work, but that dude, behind the scenes, he owns a lot of permanent whole life insurance with that kind of money that he has. So whatever you hear from these people, I mean, realize they have a bias, but this guy has whole life. But I want to show you some products that have stood the test of time. My top. Let's see if you can see this. Let's see if I can blow this up. Here we go. There we go. But check this out. Look at this. This is whole life. And again, whole life, the cost of insurance. Like that name sounds, whole life, it goes for your whole life. The cost of insurance is fixed. Whereas with like an index universal life, a variable universal life, it's called an annual renewable term, which means the term insurance cost would go up. But whole life, the insurance cost is fixed. Now, the downside to this is it's not real flexible, meaning your premium payments, you can't adjust those premium payments. But if you have a little bit of money, more secure, and you want to save some money, check out these returns. This isn't pie in the sky theoretical things here. This is what actually happened. But this is for a 45-year-old male, preferred not tobacco, $1 million face amount. Check this out. Guaranteed death benefit. And again, I'm not going to be company specific because I'm not captive. Represent a lot of these different companies. But there's a lot of good companies out there. But again, it depends on how you structure the policy. But this is your basic, boring whole life, which goes for your whole life. But look at this. Penn Mutual, guaranteed whole life. Internal rate of return year 20, 9.13% for your death benefit. Year 30, 6.54%. But look at the cash value, 4.26% for year 20, 4.72. That's not bad. To have access to your money, have a savings account, 4.26% in 20 years. I mean, where in the world can you get that? What bond's going to give you that? What corporate bond's going to give you that? What Ginnie Mae's going to give you that? What, I mean, where are you going to get that? What money market account? What savings account's going to get you that? You get $1 million of face amount, internal rate of return 4.26%, tax deferred, and you can leverage this policy by taking tax-free loans. But look at New York Life right here. 8.36% death benefit, 6.11 after year 30, 3.92%, 4.48% year 30. Look at these companies. Now, these are companies that don't mess around. They have a good whole life product. And there's some companies out there that have garbage whole life product. But look at Mass Mutual. Let's just focus on the cash here. 3.69% year 20. That's your internal rate of return. That's what you would need. What that means, internal rate of return, what you would need to get in a comparative market vehicle. Again, we talked about Ginnie Mae's. We talked about corporate bonds. We talked about treasury securities. We talked about CDs, money market accounts. And throw out the equity because whole life should not even be in that conversation with the stock market equity, with the ETF or anything like that. This is for the fixed portion of your portfolio, but you can see you can use this as your own bank if you really know how to leverage this. But again, the downside of this is if your money's tight, the flexibility is a key. But if you do have some money and able to make payments, this whole life it can work. And I'm a fan of whole life, and I'm a fan of what a permanent life insurance. I think term life insurance has its time and place, and you need to know when to use term life insurance, and you also need to know when to use whole life insurance, or universal life, or index universal life, or variable universal life. But depending on your situation, these products that you can see, they can become an incredible part of your portfolio. Mass Mutual, 3.69 year 20, 4.25% year 30. Look at these numbers. And then let's just go to the bottom here, cut to the chase. But National Life, 2.61% year 20. Internal rate of return, 2.92% in year 3. So you can see the difference in the crediting of whole life. And again, whole life's based on the performance of the company. It's not based on it's not tied to an index like the S&P 500 or the Dow or an international index or anything like that. It's based on the mortality experience of the company, how they control their expenses within the company. But you can see here, Penn Mutual, New York Life, Mass Mutual, smoking whole life. So old school whole life still has a time and place in that portfolio, can accomplish some different things for you. All right, keep it locked loaded right here, Stanek Financial.